Hey everyone, I am back with another video about dividend stocks. I want to discuss 3 different dividend stock picks in the video today. I believe all 3 are compelling values right now in this stock market in September of 2021, and I believe all 3 of these are trading at reasonable valuations with massive starting dividend yields. In particular, I want to share these 3 stocks for people like myself. I'm now in my 40s, and as I head into the later years of my life, I'm gearing up for my financial freedom, for my retirement. And so these are the types of stocks that people like myself and older might want to take a look at. And so I'm addressing this video to investors in their 40s, 50s, 60s, 70s, and beyond. And in particular, these types of investors want a few things. Check it out on the screen right now. What you can see in front of you is these types of investors want cash flow to pay bills. They want high starting yields because once you're in your 40s, 50s, 60s, 70s, either you're aspiring to achieve financial freedom or you're already there. And how do you achieve financial freedom? That's through paying bills with dividends. And so investors in these age brackets typically also want a margin of safety. They don't want to overpay for an underlying equity just because there are fewer years for overvalued stocks to catch up, for the earnings to catch up with an overvalued stock purchase. And so the stocks I'm sharing today, I believe that they're at compelling values. Also, these investors want growth. They want the company to grow, the dividend to grow, because we all know right now in 2021, the cost of living is increasing. And so we need our cash flow to keep up with inflation as we use dividend stocks to pay for our retirement. Also, these types of investors want stocks that have stood the test of time. They want stocks that will last and will serve them well, not only in their lifetime, but can also be passed on to future generations. This is something I think about a lot as it pertains to my own kids. I want to pass on my investment portfolio to them. Also, investors in their 40s, 50s, 60s, and 70s want to make the right decision. They want to avoid mistakes because when I was younger, I was investing in my 20s and 30s, even my teenage years, it was okay to make mistakes from time to time. And I made a lot of them. I've shared a lot of them here on YouTube. But now, as I head into the later chapters of my life, I get a lot closer to financial freedom. I don't want to be making mistakes. And so that's something that I think investors who are older, who are either in financial freedom or getting closer, they want to avoid mistakes. And so I'm going to share 3 stocks that are top of mind for me right now, and those are AbbVie, Altria, and also XYLD. I'm going to go through all 3 in great detail. So get ready, everyone, for a really exciting dividend investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So the first stock I want to go through today is AbbVie. Check it out on the screen right now. I want to do a metrics overview, and then I'm going to get into some company-specific news. So AbbVie is a large pharmaceutical company. It's almost a dividend king, if you ask certain investors like myself, by association with Abbott. AbbVie and Abbott used to be the same company. They split apart around 2013. But if you actually look back at Abbott, I think they're at 49 years of dividend increases, and they're heading into their 50th pretty soon here. And so by association with Abbott, I do think that AbbVie is a dividend king. Now, different investors may look at that different ways, but it has a rich heritage, a long track record of success. Now, the price per share has fallen because of some bad news that came out yesterday, and I'll share that in a minute. But I love this because it's trading at a compelling price of $112.62. If you look at the forward earnings guidance that the analysts are expecting based on company guidance, it's trading at a forward PE, adjusted diluted earnings of 8.9. 8.9 forward PE in 2021. Next year, even lowered in 8.06. Getting a stock, a world-class company like AbbVie, in the 8 PE range is definitely a value. There's a margin of safety there. And so for investors in their 40s and beyond, this can make a lot of sense because you know you're not overpaying for a stock that is trading at really high PEs. Now, what I love about this company as well is with its current dividend per quarter of $1.30, it's trading at a starting dividend yield of 4.6%. I highlight that because I would consider that a relatively high yield given the overall stock market and interest rate environment. And with a payout ratio of only 41%, there's room to increase that dividend over time. And in fact, you can see their very last dividend increase, which was a few quarters ago, they increased the dividend from $1.18 a share to $1.30, which is a 10% increase. And if you look below here, I have the 5-year ago dividend per quarter was 57 cents. And so on average per year, over the last 5 years, they've grown the dividend by 17.9% per year on average, which again is a great metric, a great number, because anyone in those retirement years here is potentially not only locking in value at a starting PE of 8, but is also getting a dividend yield. It is a strong 4.6%, and that dividend is growing each year on average for the last 5 years at least by almost 18%, with the last increase being 10%. So that definitely keeps up with inflation. Now you can see on the screen as well that the stock chart is up and to the right. And so over time, this is a stock that is gaining value in the underlying equity, which is also an important requirement, in my humble opinion, of a dividend stock in general, that it is growing over time, because a company is typically either growing or shrinking, in my humble opinion. Now, if I look at my first tranche analysis, I have that on the right. I bought my first tranche in 2019 at $69.02. My starting, or my yield on cost for that first tranche, not counting reinvested dividends, is 7.5%. The way I calculate that is I take the dividends per year now, which is 520, I divide by 69.02. Now, my lowest tranche, the lowest amount I paid for this stock, was in August of 2019 at 64.99. My simple yield on cost there is an 8%. And so this just shows over the course of a few years how this stock can drive great returns, great yield on cost for a dividend-oriented investor. Now, what do I like about this company? I like that they merged with Alergan, and so that reduces their dependency on Humira. Humira is a blockbuster drug. It is I think it's the most highly utilized prescription drug in the United States at this time, I believe, or one of them at least. And so for a while before they merged with Allergan, AbbVie was so dependent on that one blockbuster drug, and it is going to be coming off of patent protection soon here in the United States. It already has in Europe. We'll look at some of those metrics in a minute, how that patent cliff, if you will, can affect something like this. But thankfully, they've reduced their dependence on that particular blockbuster drug. Now, worth noting, they paid for that Allergan merger and took on a lot of debt because of it, and so that's the other side of the story. But I do like now that they're less dependent on Humira than when I first purchased this company in that $60 range. Now, let's keep going. Check it out on the screen right now. What else do I love about this stock? I love the rapid dividend increase. It definitely keeps up with the cost of living. I love the low PE. There's that built-in margin of safety, and I like that it's a value stock. I also believe that it's 1 year from being a Dividend King, as I mentioned. Now, some people will dispute that because it did split apart AbbVie and Abbott, but I still look at them as having the same heritage. Now, I would say the growth is simply amazing. This is just a company that has been executing. What I don't like about this company is the U.S. regulatory environment on big pharma is stringent, and the FDA, it seems, is making moves that could potentially impact this company. And so that's something that we have to keep an eye on over time. There will always be politics. I think, politically speaking, there are some folks out there that would like to potentially go after big pharma, and so there's risk with any investment. Now, I'd also say there's still concentration of that blockbuster Humira, although it's better after the Allergan merger. It's now only about 36% of revenue. I remember before the merger, it was, I think, up at like 50% or somewhere around that range, if I remember correctly. Don't quote me on that one, though, because I don't fully remember. That was from a while ago when I did my research in 2019, which I will link to in the description below, my original research on this company. I don't like that they have $82 billion in debt, although I think they'll be able to pay that down over time because of the incredibly strong company performance. Now, with that, I want to get into some recent news with AbbVie, and I have some exciting stuff to share. So check it out on the screen right now. Actually, what I'm going to do first is I'm going to get into the not so exciting stuff, and then I'm going to get into the more exciting stuff. So the first thing you can see is basically the FDA came out, I believe, yesterday, and they basically said that there's an updated safety warning and restrictions from the FDA as it pertains to AbbVie's JAK inhibitor. And so the FDA is revising some of Rinvoq's warnings. Also, they're limiting the drug's use to particular patients, and so they're going to limit it. And so basically, when this news came out, the stock tanked, and so that could potentially create a buying opportunity for a long-term oriented investor. Just as someone who's investing for a very long time, I've been investing for over 20 years. Typically, what I've seen in the stock market with well-established dividend stocks is XYZ piece of bad information comes out, the stock tanks, and over time the company figures it out and goes on to new heights. That's kind of how I look at this particular piece of information, but I would say I'm not an expert in what the FDA is saying here. I'm not an expert on these particular drugs. I'm sure there's people in the community who are, so please share your thoughts in the comments below. But I'm just speaking at a macro level that there's no business in the world that does not face hurdles over time. Every single business that I invest in more or less faces a hurdle from time to time, and when a hurdle comes up, typically it creates a buying opportunity, and that's how I'm looking at this for AbbVie right now, without digging into the news, honestly, more than a surface level look. Let's keep going. Check it out on the screen right now. The next thing I want to say about AbbVie is that their second quarter 2021 earnings were stellar. And I'm not going to read all of these numbers, but basically what I'm trying to illustrate on the screen is that this company is just hitting the ball out of the park. And I think the most exciting thing is just all the way there at the bottom of the headline in bold, they are updating their 2021 GAAP diluted EPS range, and they're raising their 2021 adjusted diluted EPS guidance range. And so things are up and to the right. They're basically saying here all the way at the bottom, worldwide net revenues were $13.9 billion, an increase of 33.9% on a reported basis, or 19.3% on a comparable operational basis. And so you're seeing a company here that is growing at 19% revenue on an operational basis, but it's trading at a PE of 8. And they're growing their dividend on average by about 17% per year. The last increase was 10%. I think 10% is more realistic going forward, because 17%, that can't continue in perpetuity. But what I'm saying here is the company, it's not at a PE of 8 because it's shrinking or declining. It's at a PE of 8 because it's trading at a value range, and the company is growing really substantially. And so again, for someone like myself, someone who's now in his 40s, and I'm kind of looking towards my early retirement, I'm getting closer to it by the day, at least my semi-retirement, having the ability to have more options in life, having the freedom, the peace of mind of the cash flow coming in, really getting to spend my time day to day on what I love the most, having stocks like this in my portfolio make a lot of sense. And so for me, at least, speaking of my personal situation, I really like AbbVie for my particular portfolio. Now, I want to share one last screenshot. Check it out on the screen right now. And so the last one I want to share is actually from Abbott Labs website. And the reason I'm sharing this is why I believe AbbVie could qualify as a dividend king. And I just want to share the heritage of this company as well, and why I love dividend-oriented stocks for people who are, like me, interested in living off of cash flow. And basically what it says is dividends are an important part of Abbott's heritage and investment identity. First and foremost, that speaks volumes. This company cares about dividends, and AbbVie does too. Abbott has declared 390 consecutive quarterly dividends since 1924 and increased the dividend payout for 49 consecutive years, so on and so forth. And so This is music to my ears. As a dividend stock investor, I want to own companies that care about the dividend because I need the dividend to pay my living expenses. And Abbott and both AbbVie fill that criteria. So put in the comments below, what do you think about this first pick for investors in their 40s, 50s, 60s, 70s? Honestly, I think this is a really cool dividend stock for any dividend investor, but I certainly think it has a persona, it has a characteristic as well that skews nicely for portfolios like mine as I head into my later years. And so also, before we continue, if you're enjoying the video so far, please go ahead and smash the like button. It really helps me out. It helps these videos reach more investors, and I want this knowledge to get out there on YouTube. And also, don't forget to subscribe. I have new videos on the way all the time. And before we continue, just a friendly note. Today's video, it's not investment advice. I'm speaking generically about my own particular situation as someone who's in his 40s, who's heading into those years where I'm getting a lot closer to my early financial freedom. And so just something to keep in mind. Today's video is just for entertainment. Let's keep going. I want to talk about Altria. So check it out on the screen right now. The next stock pick today is Altria, and I really love this company. This is a stock that I personally own and have owned since 2009. And so let's talk about the metrics. The stock is trading at $50.71. With the forward guidance and analyst consensus estimates for 2021 and 2022, that PE is in the 10 range. And so a little more expensive than AbbVie, but still very low, which makes a lot of sense for a value-oriented investor who wants a margin of safety, who cannot afford to overpay for a stock. That's a wonderful PE. Now, this is a CPG stock, consumer packaged goods, and so it's a little bit different than the last one, which was a pharmaceutical. I also love the fact that it is CPG because this adds diversification to this 3-stock sample portfolio that I'm sharing today. And with the current dividend of 90 cents per quarter, it's a 7.1% starting yield, which is fabulous. Payout ratio is 77.9%, which is just below the company's target of 80%. And the 5-year dividend growth rate on average has been 8%, 8.1% per year, although the most recent increase, which was literally just announced, was 4.7%. And so again, this is the type of stock that could keep up with the pace of inflation during an early financial retirement, financial freedom. Now, my first tranche analysis, I bought my first tranche in 2009 at $15.99. So my simple yield on cost, not counting reinvested dividends, is 22.5% on that first tranche. And this is a Dividend King with 56 dividend increases in the last 52 years. Now, you can see the stock chart. It's up and to the right, although it has had some weakness in recent years, which I love because this is the type of stock that is always on sale. And so what I like the most about this company, and a lot of people don't know this, but many studies have cited that this is the best performing stock of all time, because what a lot of investors don't realize is Altria used to be combined. It was a combined enemy with Philip Morris International, with Kraft Heinz, and with Mondelez. And it was Kraft before they had Heinz as part of it. But basically, this combined company spun off Kraft and Mondelez. And Philip Morris International and Altria broke apart too. But when you look at all of those stocks together and you understand the history of them over time, this has been the best performing stock of all time, according to certain studies. Now, that might be changing in more recent years because of companies like Amazon, for example, but this has certainly been a solid performer that has rewarded shareholders over the years. I love that it almost always has a low PE, so for someone in those retirement years or close to them, it's the kind of stock where I never feel like I'm really overpaying for it. It's always trading at a low PE, and I think that's because society really looks down on this company, and there are a lot of mutual funds, for example, that are more socially conscious that just can't buy it. Their investment charter says, hey, we can't buy it. They have a strong starting yield, which makes a lot of sense for someone like myself who uses dividends already to pay bills and will increasingly be doing so in the next few years. And they have strong dividend growth. I love that they have an innovative product called IQOS. It's a heated product. It is really gaining traction, although they are facing some patent challenges on that right now in the United States. And so that's something to keep in mind. It's a Dividend King. Now, what I don't like is the U.S. only focus, and the U.S. is very stringent. The FDA, the authorities that keep these types of companies under regulation, they can be tough at times, but I would say Altria has a very good track record of working with the regulators and making sure that all stakeholders win. Now, something else I would say is there's societal pressures and negativity. And so that's a good thing in that that's why it's probably always trading at a discount. A lot of mutual funds can't even buy it. But at the same time, this is the type of stock where even when I share it on YouTube, a lot of people question, why are you buying this quote unquote sin stock? Certainly, I live in California now, but I'm going to be moving out of California. Here in California, you can't really talk about owning a stock like this, especially in the Bay Area, because a lot of people would just look down upon you. And so there's that side of it, but it's okay. Just keep your personal finances to yourself, I guess. Now, the other thing I would say is everyone always feels like they're at an inflection point. There's going to be a point where the pricing, so far their core product that they sell, the amount of volume of consumption's been down over many decades now, I think even since the 70s, but pricing has made up for that. But over time, will there be an inflection point where it just doesn't work anymore? And so that's always a concern that investors have had. Now, what I would also say about it as well is they've made some bad acquisitions in recent years, such as JUUL, and that cost them a lot of money, and that's probably why the stock is down in recent years. But I look at that as an opportunity for a long-term oriented investor, and it's kind of like going back to AbbVie. AbbVie's facing a few challenges now from the FDA. Altria is facing a few challenges just with their books because they overpaid for some bad acquisitions such as JUUL, and that's pushed the stock down, and it has created an opportunity, in my opinion, for long-term investors. And what I would also say is this is just about the only company that could make acquisitions this bad and of this magnitude and still make it through it while increasing the dividend all along the way. And so with all of that, let's keep going. Check it out on the screen right now. I want to share some recent news from Altria. And the news I want to share is, hey, the dividend. They increased the dividend by 4.7% to 90 cents per share. And so that's really exciting. That's great news. And it just goes to say it's the 56th dividend increase in the past 52 years. And so this is a company that really cares about their shareholders and their dividend. And quite frankly, they want that cash out of the company, so people can't come after it. They want to just get it to the shareholders. And so that's another reason for someone in those more retirement-oriented years to look at something like this potentially. I know I do for my personal dividend stock portfolio. And so I have one more thing to share on Altria. Check it out on the screen right now. And in this screenshot, it just shows their 2021 second quarter and first half results. And basically what I want to share is a lot of people, again, would think, hey, it's trading at a PE of 10. It must be shrinking. Oh, their product. No one uses those products anymore. It must be shrinking. They must be losing money. That is not the case. If you look just at the numbers at the bottom, when you look at Q2 2021 and you compare it to Q2 of 2020, revenues are up. And reported diluted EPS are up. Adjusted diluted EPS are up. When you look at the first half of 2021, you compare it to the first half of 2020, revenues are up, reported diluted EPS is up, adjusted diluted EPS is up. It's up and to the right. And what I think is even more exciting about these numbers is the fact that last year was a tough comp. I see this in a lot of my CPG, consumer packaged goods stocks. There was a lot of hoarding last year, like a lot of people stocking up on toilet paper, for example. I think a lot of people were probably hoarding the products that Altria sells as well for fear that with the pandemic, maybe they couldn't make it to the liquor store or to the grocery store or to wherever to go shopping to purchase these products. And so a lot of people were hoarding. They were preparing for the apocalypse. And so now that we're in 2021, a lot of people are just going through the stockpile that they were hoarding in 2020. And so that has created a pressure on a lot of companies in the CPG space. But the fact that this company is showing year over year growth on the quarter and on the entire half of the year just goes to show how strong it is. And so again, you're trading at a PE of 10. The dividend is growing, the revenue is growing, the earnings are growing, the numbers are good, and it's producing a lot of value for shareholders. And so it's one of these stocks, I'd say both AbbVie and Altria, they're very rare where you get the deep discount value, but you also get the growth. And I think a lot of investors ignore that. They just think that these are shrinking businesses, whereas they're not. They're growing businesses. And so those are great companies, in my humble opinion, for probably a lot of dividend investors, but especially people who need cash flow now, who need the value, who can't really afford to overpay. Because someone, for example, with more time on their hands, maybe they can buy a CPG stock, just a traditional CPG stock that is trading at a very high PE, say in the mid 20s, and just wait because time will resolve kind of buying at an overvalued point. But an investor in those retirement years, there's just not as much time to buy stocks that are at overvalued prices. I want to go with one more investment option today. And these honestly are three stocks that I'm looking at very closely right now for myself personally. Right now, I'm trying to save a lot of money because we're moving from California to a new state, and there's a lot of money required for the move, for the down payment, for all of that. But at the same time, I'm also thinking at a meta level, like next 5 years, where am I at? Increasingly, I want to use dividends to pay bills, or at least have the option of having dividends cover bills. And so because of all of that, these are the types of stocks that meet my personal needs at this time in my life. And so I want to keep going. Check it out on the screen right now. And so the last one I want to share today is XYLD. This is a covered call ETF. I will share links in the description below. I've done a lot of videos on XYLD lately, so I don't want to share too many details here in the interest of your time, but the purpose why I'm including this in this 3-stock sample portfolio today is for diversification. The first stock was pharmaceutical. The second one was consumer packaged goods. The third one here is completely different. It's a covered call ETF. This is an exchange traded fund that writes covered calls, basically buys the S&P 500 index and then writes covered calls against it. And in doing so, it's able to distribute about a 9% distribution yield per year. And it's paid monthly as well, which is great for retirees because the income comes in predictably every month. Now, what I love about this is the very high distribution yield. But what I would say, just to be clear, is these are not qualified dividends like AbbVie and like Altria. This is an ordinary income / return of capital type distribution. And so the tax consequences are different. Typically on something like this, the taxes are going to be higher. But again, for someone in the retiree years, especially once all of that earned income goes away and the retiree is living off of dividends, something like this, in my opinion, could make sense because if there's a lot less ordinary income coming in, yes, ordinary income is going to be at a higher tax rate, but because that whole level is lower, this may make sense in certain retiree portfolios, especially, or certainly I'm looking at it for mine and I continue to build up this position. What I also like about this position is it provides alternatives. Sometimes in life, there are big expenses that come up, and I never like selling a dividend stock, but I look at this one more as kind of cash management. And so if I had to sell something in my portfolio right away just to pay for an expense, XYLD, that's kind of how I look at this one, kind of intermediate term, long-term cash savings. Now, check it out on the screen right now. As is consistent with all 3 positions shared today, the stock chart is up and to the right, although in this one, it's more flat, and it did have a large downturn there in 2020, so that is something to keep in mind. What I like about this is the monthly cash flow is perfect for retirees. I love that there is long-term preservation of capital because a lot of these covered call ETFs, they're not preserving the capital over the long term. Or I shouldn't say a lot, but at least some of them, like QYLD, which I know a lot of people love, so I don't want to speak down on it, but QYLD over long periods of time, at least based on the stock chart, it does seem like the underlying capital is being eroded. Now, I like that it has a long track record. There are a lot of ETFs in this covered call space that are newer, like within the last year, but this one's been around at least since 2013, and so that's nice to see. Now, what I don't like is there can be periods of volatility like in 2020 where it just tanked. And so that's something to keep in mind, although it did recover pretty quickly. But there is risk with this. They don't have downside protection. They don't buy puts. And so I would also say distributions are not qualified dividends. And so they're part ordinary income, part return of capital. And again, downside protection. And so they don't have it, but that's why the yield is a little bit higher. But personally, this one makes sense for my needs because I do believe that over periods of time, even if it does tank in the future, like it did in 2020, the history at least shows that it will come back. And also what I know is during periods of volatility, that's when the premiums on options can go up. And because it's a covered call driven strategy, the cash flow should be really good during periods of volatility. And so Let me know what you all think in the comments below. I would love to hear what you think about these three positions for investors in their 40s, 50s, 60s, 70s, and beyond, but also for younger investors too. I think these are great for younger investors as too. All right, everyone. I really appreciate all of you in the community. We are 81,000 dividend investors strong. Please go ahead and smash the like button if you love dividends as much as me. And please also go ahead and subscribe. Also, if you enjoy the shirt I'm wearing today, you like this, I have a cool store of custom merch. Check it out in the pinned comment below. You can buy this very shirt that I'm wearing now. I love this one. And I know many of the in the community already have. And each purchase you make, it supports what I'm doing here on YouTube and with this channel, with my crypto channel as well. Also, I have a Patreon. Check it out in the pinned comment below. If you like this video and you want even more motivational content, I have 45 videos that you will unlock instantly when you sign up for my Patreon. It's really cheap. It's only $3 a month. You can cancel at any time. I have a $10 level too, which has a lot more perks. So consider that one as well. And that's a great way you can support my efforts here on YouTube and social media and beyond. All right, everyone, before we leave today, in terms of a full disclosure, I own the stocks mentioned today. I am long Altria, ticker MO. I'm long AbbVie, ticker ABBV. I am long XYLD as well. And I am also long Philip Morris, ticker PM. Before we leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. It's possible to lose a ton of money in the stock market, and all of these stocks and the ETF, all the positions mentioned today, they do carry risk, and certainly any stock trading at a value price contains an element of risk. So whereas this makes sense for my personal portfolio, it may not make sense for anyone else. So please just keep in mind, I'm sharing my personal journey here today for fun and entertainment, and check out the additional disclaimers in the description below, and make sure to seek out financial advice from a licensed financial advisor before making any decisions. Also, today's video is not tax advice either. All right, everyone, I love you all. I'll see you in the comments below, and I'll see you in the next dividend investing video.